we've been putting on related to some of the relief and some of the special circumstances that exist as a result of the COVID-19 pandemic. Today we're going to be talking about the Main Street Lending Program. A couple of housekeeping notes before we dive into the substance. This session is being recorded, and we hope to have the recording available as well as the materials from today's presentation sent out to everybody probably by tomorrow or roughly 24 hours from now. So you will be receiving access to the recording and a copy of the slides by email. All of the participants today have been muted throughout the presentation, and so if you want to send any questions during the presentation, feel free to use the chat function. Probably it appears either at the bottom or sometimes on the side of your screen, and if we see questions, we'll attempt to respond to those as they come in. It's always fun to be a bit more interactive. So I think with that, we're going to get started. As I said, this Main Street Lending Program is, well, let me say first kind of I guess maybe the big thing to acknowledge right at the outset is that this is a program that is not up and running yet. And so even more so than the Paycheck Protection Program, which we talked about last week, and even more so than some of the employment tax incentives and issues that we talked about a couple of weeks before, details of this are still really vague, and obviously we expect that we'll learn more before this program is fully up and running. So we're going to start by just talking about, kind of in broad strokes, what's the purpose and the scope of this program, who is an eligible borrower, who's eligible to borrow money under this program, what are the terms of each loan, how do eligible borrowers apply for loans, and then what are some of the required certifications and covenants that borrowers are required to give in order to qualify for loans under one of the programs. So Main Street Lending Program at a high level was created, or maybe I should say will be created, to provide loans to small and medium-sized businesses during the current period of uncertainty caused by COVID-19. We'll talk in a bit about what the definition of a small or medium-sized business is. As a preview, I will say that it seemingly will encompass just about every business other than maybe the very, very largest companies in the country. The loans can range in size from as little as $500,000 to as much as $200 million. For those of you that may have read up on this program a bit earlier, that is a slight change from the initial announcement of the program said that the loans were going to range from $1 million to $25 million. And as we'll talk about, that's now been reduced at the low end to where you can have loans as small as $500,000. And it's been increased at the high end by the creation or anticipated creation of a third loan option for loans, as I said, as large as $200 million. The mechanics of this are that the Treasury Department is going to create, it's actually the Federal Reserve of Boston is going to create a special purpose vehicle in connection with this program. The Treasury Department is going to make a $75 billion investment in that special purpose vehicle, and it's going to purchase up to $600 billion of participation interests in eligible loans. The balance of the loans, they are going to be originated by individual banks and other financial institutions, and the banks are going to retain some interest in the loans throughout. So the risk will not be solely on the Treasury, although it will be primarily on the Treasury. The loans are full recourse loans, and they are not forgivable. So for anyone who's listening who's familiar with the Paycheck Protection Program, where a big incentive or a big feature of the loans is that they are forgivable if you use the proceeds for certain purposes. Under this program, the loans will have to be repaid. The Main Street program actually encompasses 3 distinct programs, and we're going to talk about each one of those, but it's the Main Street New Loan Facility, the Main Street Priority Loan Facility, and the Main Street Expanded Loan Facility. The 3 programs, as we'll see, are similar, but there are some distinctions among them, and the eligible borrower and eligible lender criteria are identical across all 3 programs. As I said, none of these programs is operational yet. We do expect them to launch shortly. Once they are up and running, just like with the Paycheck Protection Program, borrowers are going to make application through an eligible lender, which we'll talk about, but again, it's essentially a bank or a credit union or other financial institution. The program is going to run through September 30 of this year, unless it's extended by the Federal Reserve or the Treasury. And then depending on the program, the lender is going to retain either a 5 or a 15% interest in each loan, and the special purpose vehicle is going to purchase the balance. And then after that September 30 date, the Federal Reserve Bank of Boston is going to continue to operate that special purpose vehicle until such time as all of the assets have matured or have been sold. The updates on the program, including the date on which loans are going to become available, is going to be published on the Federal Reserve's Main Street page. I've included the link there. Last week, or I think it was April 30th, the Federal Reserve published about 20 pages of frequently asked questions. So we do have some more detail on the program, but as I said, still a lot of questions to be answered. So why don't we dive in by talking about who is an eligible borrower? Obviously, the very key consideration is for any business is whether you're actually eligible to benefit from this program. So an eligible borrower in general is a borrower that has to meet the following 7 criteria. First of all, it has to be a business that was established before March 13th of this year under the laws of the United States, the state, the District of Columbia, a territory, or a possession of the United States or an Indian tribal government. So it has to be organized in the U.S. It cannot be an ineligible business, and here an ineligible business tracks with what the Small Business Administration defines as ineligible, and I've included a cite to their the regulation where they list ineligible businesses. However, the most recent guidance that we have says that they interpret those effectively in the same way as they do for the Paycheck Protection Program. So, for example, SBA regulations typically don't allow loans to gaming businesses or businesses that derive more than 1/3 of their revenues from gaming, including even legal gaming. So, legal casino businesses, riverboat gambling businesses, even if it's a legal business in the state in which it's operating, they generally aren't eligible for SBA loans. However, the SBA has made an exception for Paycheck Protection Program loans. And so here, that same exception would apply. Some other businesses that are considered ineligible are financial businesses that are engaged primarily in lending, passive businesses, life insurance companies, and there are some others, businesses that, what I think people sometimes refer to as sin businesses, businesses involved in, sort of topless clubs. Those types of places are not eligible for loans. The third condition, and this is really probably the key one, is that the business has to meet at least one of the following 2 conditions, but is not required to meet both. It must have either 15,000 or fewer employees, form must have had annual revenues in 2019 of $5 billion or less. This, again, is a change from the initial iteration of the program. Initially, the standard was going to be 10,000 or fewer employees and 2019 annual revenues of $2.5 billion or less. We'll talk in just a minute about how those are measured. But, you know, as compared to the Paycheck Protection Program, I saw a statistic somewhere that said, so the Paycheck Protection Program was open, generally speaking, to businesses with 500 or fewer employees. And I read somewhere, and I'm not certain that this is true, but it makes a kind of sense, that 500 or fewer employees actually included something like 99.5% of all the business entities in the United States have 500 or fewer employees. So with a standard like this with 15,000 or fewer and $5 billion or less of revenue, I have to believe that this program is going to apply to virtually all businesses in the country, with the exception of maybe the very, very largest, and obviously those that are ineligible, you know, by nature of their industry or activities. The business has to be, in addition to being created and organized in the United States, it has to have significant operations and a majority of its employees based here in the United States. So, not surprisingly, you know, the relief here is targeted toward U.S. businesses, and generally, you know, foreign businesses are not going to be eligible. Businesses may only participate in one of the three Main Street lending facilities. So they either have to do the new loan facility, the priority loan facility, or the expanded loan facility. And they also cannot be participants in the Fed's primary market corporate credit facility. In order to be eligible, a business cannot have received a specific allocation of support under Section 4003B of the CARES Act. Generally, what they're talking about here are passenger air carriers, cargo air carriers, and certain businesses that are integral to national security. So, certainly for businesses in those industries that received a specific allocation under the CARES Act, they cannot also benefit from this program. And then finally, and it almost goes without saying, but the business has to be able to make all of the certifications and covenants that are necessary under the particular Main Street program. Some other general conditions in order to be an eligible borrower, and we're going to talk about what some of this means, but basically there's a requirement that the borrower must have been in sound financial condition prior to the onset of the pandemic. And that's sort of consistent with the purpose of these loans, which is to help businesses that, you know, were in good shape and were, you know, showing a profit or were in good condition to maintain their operations and to maintain their payroll during what's really, you know, a time of unprecedented economic disruption that business really, you know, could not have prepared for or you know, easily anticipated. Borrowers that have already received paycheck protection loans are eligible to borrow under the Main Street facility, so you can have both a PPP loan and a Main Street loan at the same time. So let's talk for just a minute about what a business means for this purpose. So in the frequently asked questions that were published the other day, a business is defined to include a corporation, association, partnership, limited liability company, a trust, cooperative, a joint venture with no more than 49% participation by a foreign business entity, or a tribal business concern. So that really does encompass just about every form of business that we commonly see. I suppose it does exclude like sole proprietorships or unincorporated businesses, but certainly it seems as though this is going to apply quite broadly to really any type of for-profit business. And conversely, nonprofit businesses currently are not eligible to participate in the program, but may be considered for participation in the future, according to the frequently asked questions. Interestingly, the reason that was cited for why nonprofits cannot participate is that the program, to a certain extent, looks to a business's EBITDA, or earnings before interest, taxes, and depreciation. And so with a nonprofit, because they don't measure their results by EBITDA, I think there was some question about how the Federal Reserve and the Treasury could determine whether a particular nonprofit was eligible to participate. And likewise, the Treasury and the Federal Reserve have said that they will consider adjustments to the program in the future to allow asset-based lending. So presumably for businesses that maybe don't have the earnings or profits or EBITDA to support a loan, but may have valuable assets, they may be eligible to borrow under this program under future guidance, but are not as of today.
So Ivan, a question here is, as you mentioned, sole proprietor, individual sole proprietor doesn't seem like qualifies, but if an individual organized as a single member LLC, would it qualify or not? The guidance, is there any guidance about it?
To this point, there's not that I'm aware of. I mean, they say, if we go back a slide, they say limited liability company. So I would think that a single member limited liability company should qualify. But there's no specific guidance as to whether or not it would.
Right.
So for purposes of counting the 15,000 employees, the most recent guidance tells us that the Small Business Administration rules under 13 CFR 121-106 apply. And generally what those rules tell you is that all full-time, part-time, seasonal, and other employees are counted. Only volunteers and independent contractors are excluded. And generally, under these rules, businesses have to use the average number of employees for the preceding completed 12 calendar months. So if, in fact, this program gets up and running sometime in the month of May 2020, you would use your average number of full-time employees, or excuse me, average number of employees for the 12-month period ending April 30 of 2020. For this purpose, they're just looking for total number of employees. So part-time and temporary are counted just the same as full-time employees. However, the SBA has a rule which says that if an employee works less than 40 hours per month, he or she is not counted as an employee. And I would assume, although I suppose I don't know for certain, but I would assume that that same rule would apply here. So if you have employees who are really working, very, very limited hours, they're not necessarily counted. At the same time, I would say with a limit as high as 15,000, I would expect that the overwhelming majority of businesses are going to qualify for as eligible, at least based on that criteria, and if they satisfy the others, they should qualify. The SBA's affiliation rules at 13 CFR 121-301 also apply. Those rules, essentially what they say is they look to whether the business is either controlled by or under common control with another business based on either ownership, management, or sometimes an economic interdependence. So there's a whole set of rules, but kind of seemingly the most important factor is control. So if you had one business with 1,000 employees and another business with 2,000 employees, and they're both commonly owned by a business with 500 employees, your number of employees there would be 3,500, not, you wouldn't, because you have to apply the affiliation rules in determining your number of employees. Again, even with those, even taking account of those affiliation rules, I think the overwhelming number of businesses are going to qualify because 15,000 is such a high threshold. The other key factor, and again, just to repeat, this is an or, not an and. So a business, again, assuming it's otherwise eligible, it is eligible so long as it doesn't have more than 15,000 employees and more than $5 billion of revenue. If it satisfies either test, it's an eligible borrower. So for purposes of measuring revenue, the business can use its and its affiliates either their 2019 annual revenues per 2019 audited financial statements prepared in accordance with GAAP, or their fiscal year 2019 annual receipts as reported to the IRS. Receipts for this purpose has the same meaning as it's defined in SBA regulations. And if a borrower does not have 2019 audited financial statements, the most recent guidance says to use its most recent year, which in most instances would be 2018, but there may be circumstances where it's some earlier fiscal year period.
So Ivan, this is to ask again, the one other question that comes up to my mind is, what if a business was organized in 2020 so that business has no past history,
Right. I think that, so that's a good question. I think that, as long as the business was organized by March 13th of this year, and obviously as long as they otherwise are eligible, don't have more than $5 billion of revenue or 15,000 employees, they should qualify. The caveat, and this is what we're going to talk about in a little bit, is that banks are being directed to apply their usual underwriting standards. So for many businesses that have a very limited operating history, if they've only been operating for a couple of months, banks may be reluctant to say that, they're in sound financial condition, or just maybe they just may conclude they don't meet the underwriting standards and they're concerned about their ability to repay the loan. But I think kind of on the face of it, I don't believe that they're sort of per se ineligible.
Got you. Thank you.
So next we're going to talk about the terms of each of the different programs. As I said, there's three distinct programs. The eligible lender and the eligible borrower criteria are the same for all three. And a number of the features of each program also are the same, and that includes the maturity period for the loans, which is 4 years, the interest rate, which is LIBOR plus 300 basis points or 3%. There is a deferral of interest and principal payments for 1 year. So if you receive one of these loans, there will be no payments due for at least a year. And then there's a lack of any prepayment penalty. So obviously you can repay, you can pay early without any penalty.
So if I may interject on a couple of points here. So from what I read in the Federal Register, it seems LIBOR is a 1 to 3 month LIBOR, which I looked up right now, which is very low right now. 1 month LIBOR is 0.22%. And 3 month LIBOR is 0.44%. So I guess these loans are priced pretty cheap, around 3.2% to 3.4%. That's a pretty low rate, right?
Right. I think that's a great point to make. I mean, these are on the, subjectively, these appear to be a pretty good deal. You can get a loan that can be repaid over 4 years. At a rate of interest that's probably somewhere around 3.2 to 3.4%. And so that does seem to be, at least from in my experience, that's a pretty good rate right now, kind of relative to just walking into a bank and trying to obtain a regular commercial loan.
And also the interest is just a deferral. So the interest during the deferral period is added back to your loan amount, and that's the amount that you would pay, right? It's not forgiven. Interest is just calculated. You don't have to pay for 1 year, and then it's rolled into your loan amount, right?
That's correct. I don't believe that it's not. It's deferred. It's not that it doesn't accrue or doesn't add into the loan amount.
Gotcha.
So let's talk first about the Main Street New Loan Facility. As I said, this, like all the loans, this has a 4-year maturity, and the interest rate is LIBOR plus 3%. The minimum loan size is $500,000, and the maximum loan size is it's the lesser of $25 million, or an amount that, when added to the borrower's existing, outstanding, and undrawn available debt, and we'll talk about that term in just a second, does not exceed 4 times its adjusted 2019 earnings before interest, tax, or before EBITDA, rather. So, I mean, it's again sort of a subjective point, but that it would seem to be a pretty generous potential loan amount that you could borrow up to 4 times EBITDA. Now, that's going to be, as we'll talk about, subject to kind of the bank's own underwriting standards, but it's potentially a large amount relative to the business's earnings. In this program, in the new loan facility, loans have to be repaid, or principal rather, has to be repaid a third at the end of each of the second, third, and fourth years, and the loan cannot be contractually subordinated to any other unsecured loan or debt instrument of the borrower. So you can have a secured loan that is that would be senior in bankruptcy, but no other unsecured debt of the borrower can be senior in a bankruptcy to the Main Street New Loan. The Main Street Priority Loan Facility, again, 4-year maturity, interest rate of LIBOR plus 3%, and again, the same minimum and maximum loan size. The minimum, again, is $500,000. The maximum is the lesser of $25 million, or an amount that, when added to outstanding and undrawn available debt, does not exceed 6 times adjusted 2019 EBITDA. So again, an even more generous potential availability of borrowing to be able to take a loan of up to 6 times EBITDA. The repayment terms on this one vary a little bit. The principal gets repaid 15% at the end of the second year, 15% at the end of the third year, and the balance, or 70%, at the end of the fourth year. So it's more similar in a way to I think what I sometimes heard called like a bullet loan, or where the vast majority of the principal doesn't get repaid until the end of the 4-year term. The unique feature of this program is that the borrower at the time of origination can refinance existing debt owed by the borrower to a lender other than the eligible lender, meaning it presumably can't be refinancing debt with the same lender. A little unclear how that exactly would be applied. And then the loan has to be either senior to, or at least on kind of the same level of priority with the borrower's other loans and debt instruments other than mortgage debt. And then finally, we come to the expanded loan facility. This is the one that is a much larger loan facility. So it's available to eligible borrowers that already have either an existing term loan or an existing revolving credit line with an eligible lender that was originated before April 24th of this year and has at least 18 months remaining before maturity. The minimum size of an expanded loan is $10 million, and the maximum is as much as $200 million, 35% of existing and outstanding undrawn available debt, or an amount that, again, when added to existing outstanding and undrawn available debt, does not exceed 6 times EBITDA. This one, like with the priority loan facility, it gets repaid 15% per year at the end of each of the second and third years, and then the balance in the fourth year. And again, it has to be either senior to or at least of the same level of priority with all of the borrower's other debts other than mortgage debt. So there's a question about what does existing, outstanding, and undrawn available debt mean? The most recent guidance from the Federal Reserve tells us that includes all amounts borrowed under any loan facility, including unsecured or secured loans from any bank, non-bank financial institution, or a private lender, as well as any publicly issued bonds or private placement facilities. And it also includes unused commitments under any loan facility, but it excludes undrawn commitments that serve as a backup line for commercial paper, undrawn commitments used to finance receivables, undrawn commitments that can't be drawn without additional collateral, and undrawn commitments that are no longer available, which in a sense would seem logical. If it's not, in fact, available anymore, then it doesn't seem like it ought to be considered as an aspect of the borrower's debt. Existing, outstanding, and undrawn available debt has to be calculated as of the date of the loan application. So this next slide is really just a summary, and a very similar table is available on the Federal Reserve website, just comparing in chart form the different terms of each of the programs. As we'll see, they are quite similar, but just a handful of differences between them. Oh, the other thing that I did want to point out is that when these I mentioned at the very beginning this concept of borrowers or the special purpose vehicle purchasing interests in loans from lenders. So the lenders have to retain a small interest in the loans, and the special purpose vehicle purchases the balance. So depending on the program, in the case of the new loan facility, the expanded loan facility, the lender has to retain 5%. In the case of the priority facility, the lender retains 15%.
So Ivan, that's why lender is going to probably use a better underwriting standards here than under PPP loan program, right? Because under PPP loan program, really speaking, there is no risk to the lender, right?
That's correct, or at least it's much less risk in the sense that the lender would really only face risk if they somehow granted a loan to someone who, on the face of it, submitted a loan application that just blatantly didn't qualify for them for the loan. I think, if I'm not mistaken, in the PPP, there's an indication that it's basically the borrower rather than the lender who bears the risk if there's any misstatements and things like that. Here, though, there's a real economic risk to the lender if it offers these loans and then the borrower ends up defaulting. The lender is going to share in some of that loss. So let's talk next about how eligible borrowers can apply for Main Street loans. As I think I said earlier, eligible borrowers apply through eligible lenders, just like with PPP. You do not apply directly to the Treasury or the Federal Reserve or the SBA. And eligible lenders generally include federally insured depository institutions, U.S. branches of foreign banks, bank holding companies, savings and loans, and currently non-bank financial institutions are not eligible lenders, but the guidance did indicate that the Federal Reserve was considering that, and I think there was some potential openness to opening up this program even more broadly. And so we'll see whether or not that, in fact, occurs. So this is the key. This is the key thing that Suhas and I were talking about earlier. So eligible lenders may apply their own underwriting standards to evaluate a potential borrower's financial condition and creditworthiness. They can require additional information and documentation to make their determination, and they ultimately are the ones, that is to say the bank ultimately is the one that makes the determination of whether to approve an eligible borrower and in what amount they're approved. Just because a business is eligible for a loan does not mean they'll necessarily be approved, and it doesn't necessarily mean that they will receive the maximum allowable amount. So, Suhas kind of raised this point earlier by talking about whether a business would, how do you prove that you are of sound financial condition, or what if there's a limited operating history, or and I think these are questions that really are going to be left to a large extent to the discretion of the lender to see whether or not that borrower meets their underwriting standards, whether they consider them to be in sound financial condition and believe that they're going to be able to pay back the loan.
Right, and I guess that's also another difference in terms of PPP loan and these loans. In PPP loan, banks didn't have to look at whether the borrower was in sound financial condition. Okay, only thing the bank had to look at was whether based on their past payroll and based on their head count, whether a business was eligible. But beyond that, in PPP loan program, banks didn't have to underwrite anything as far as financial soundness of the business, While here, I think
right.
to a certain extent, lender will have to look at whether borrower is financially sound or not,
Right. And we should be careful to say, too, financially sound prior to all of the, obviously, almost by definition, businesses that are likely to want to apply for these loans are businesses that have experienced some disruption as a result of the pandemic and the economic shutdowns and so on. But you're exactly right. There's no requirement that they can apply their usual underwriting standards, and it's not sort of, as we saw with PPP, where it was almost automatic acceptance. It was, if anything, it was more just a matter of getting your loan application in on time to be at the front of the queue. So let's talk next about some of the required borrower certifications. And some of these almost go to, substantive requirements about how the borrower will use the funds. And there's one in particular that we'll talk about. But so generally speaking, with a couple of exceptions that I'm going to highlight, the required certifications are the same in all three of the programs. So in any of the programs, each borrower is going to have to commit to or certify to the following. The borrower will refrain from repaying the principal balance of or paying any interest on any debt until the eligible loan is repaid in full, unless the debt or interest payment is mandatory and due. And we'll talk about, there's another exception to that, or maybe just sort of a related exception. But, on the face of it, it seems to say you can't pay any other debt, except if that debt is mandatory and due. So clearly, if you have another loan and that other loan is, falls due on whether it's on a monthly or quarterly or annual basis, you can pay it. You just can't pay it off or pay it down before you've repaid your Main Street loan. The borrower must certify that it will not seek to cancel or reduce any of its committed lines of credit with the eligible lender or any other lender. The borrower must certify that it has a reasonable basis to believe, as of the date of origination, that it has the ability to meet its financial obligations for at least the next 90 days and does not expect to file for bankruptcy. This, again, goes to the borrower having to be in sound financial condition, shortly before the onset of the pandemic. The Federal Reserve has said they do not intend to make loans to companies that are, contemplating or may need to file for bankruptcy. Borrower must commit that it will follow the compensation, stock repurchase, and capital distribution restrictions that apply to direct loan programs under the CARES Act, except that an S-Corp or other pass-through that is an eligible borrower can make distributions to the extent required to cover the owner's tax obligations in respect of the entity's earnings. So generally, there are restrictions on the amount of compensation, stock repurchase, and distributions to owners that you would make while you have and are repaying one of these loans. However, that does not prevent a pass-through business where, where the owners are taxed currently on the business's earnings. They can make distributions at least in an amount sufficient to cover the owner's tax obligations. And then the borrower must certify that it is eligible to participate in the facility, including in light of the conflict of interest provisions, again, of the CARES Act. So the two exceptions or the two distinctions to some of these certifications are that in the priority loan facility, the borrower has to covenant I should say it's almost a carve-out rather than additional certification, but they are allowed to make a modification at the time of origination of other outstanding debt. And then in the expanded loan facility, the borrower is required to certify that it will not pay the principal balance of or interest on any debt until the upsized tranche or the additional amount that's being borrowed is repaid in full. But again, there's this carve-out for unless the principal or interest payment is mandatory and due. So in a lot of respects, it's a fairly forgiving standard. You can still pay other debt. You just can't make prepayments of other debt while you have a Main Street facility outstanding. This next one, I've highlighted it because it does strike me as sort of the most substantive, and we don't have a lot of clarification yet on what exactly it means. But each eligible borrower must make commercially reasonable efforts to maintain payroll and to retain its employees during the time the eligible loan is outstanding. Specifically, the Federal Reserve has said that an eligible borrower should make good faith efforts to maintain payroll and retain employees in light of its capacity, the economic environment, its available resources, and the business's need for labor. So, to what, obviously that's a bit of a vague standard. We don't know how loosely or strictly it may be applied. The PPP loans, there was, really sort of the entire purpose of those loans was to retain payroll and to a large extent, borrowers, while they weren't necessarily required to maintain any particular number of people, the way those loans operated was such that you had to spend at least 75% of the loan amount on payroll. Here, it's not quite as mathematical of a standard, but there is still this, good faith effort to maintain payroll for, during the entire period that the loan is outstanding. And I guess to make the picture even more cloudy, they say that borrowers who have laid off or furloughed workers are eligible to apply for Main Street loans. No indication whether or not borrowers are required to bring those employees back or to make efforts to bring them back. But clearly, it would seem that one of the criteria for for the loans is that the borrower has to, take reasonable steps at least to maintain payroll and retain employees while it has the loan. The required covenants do not prohibit borrowers from doing any of the following: repaying a line of credit in accordance with its normal course of business usage for such line of credit. So again, maybe this is the flip side of what I said earlier, which is that you can continue to pay debts sort of in the ordinary course of business or as they fall due without running afoul of the rules about priority of loans and so forth. They can take on and pay additional debt that's required in the normal course of business on standard terms. But again, it would have to be of either equal or lower priority than the Main Street lending facility. And they can refinance debt as it matures, which again is probably consistent with the prior exception, which says that you can take on additional debt while you have a Main Street loan outstanding. So that is the conclusion of our prepared materials. I think we've got about 10 or 15 minutes. If there are questions that people have added in either the chat function, feel free to use that, and we can take a look at that. Otherwise, Suhas, I don't know whether you had other issues that you wanted to highlight or talk about relative to any aspect of the program.
So I actually only based on the presentation, the only question that I have in mind is there any details available? Can you shed some light on the compensation restriction? Under if the borrower gets a loan here, or that's not completely clear?
I have to confess, I don't know all the details of that. I just know certainly at a high level that there are, restrictions about, paying certain kind of excessive compensation, using, repurchasing your stock while you have a loan outstanding or making, large capital distributions to owners. So, and again, I don't think that should necessarily be surprising that if you're getting what is effectively a pretty favorable loan, that you can't then use the money to pay excessive compensation to your owners or repurchase your shares.
Right. Got it.
So the other thing that I will say that's maybe the biggest question in all of this is that we still don't know. I think I said it very early on in the slide. We still don't know when this program is going to actually open and when the Federal Reserve will give the go-ahead to banks to begin accepting applications. The program by its terms is going to end in September, so you would think that they would want to start fairly soon. I do think that this is, to a certain extent, for those who are familiar with PPP loans, there was, I think, a total of, if I'm not mistaken, I think the total is like $660 billion that was appropriated to that program. And even that, with such a huge amount, it was subscribed for, very, very quickly. Once that money is gone, I would think that this program, while it's not in some ways as favorable because of the lack of forgiveness, this is going to become a key program for businesses that find that they need to borrow money to kind of bridge this current disruption. So we got a question. Do we have to go to the same bank we were doing business with, or can we go to any bank? So that's a good question. I think so. I'll tell you sort of the technical rule or the nominal rule, and then what may be the real rule. So I think you can, in theory, go to any bank that is an eligible lender and seek a loan once, obviously, this program has opened. You don't necessarily have to go to the same bank that you've used in the past. However, something we saw with PPP was that the banks were so overwhelmed with applications that they were limiting, they would not allow applications except from existing customers. So yet to be seen whether we see something similar with this program. I think we don't know yet how high the demand will be and whether banks will, be in a position to be able to offer the loans to other, to new customers or new clients as well.
Also, the practical answer is that if you already have an existing relationship with your banker, okay, where you already have line of credits and borrowing facilities set up, then underwriting would be quicker just because a borrower would already have a history, and so underwriting, it's easy for a bank to look at the history and the record to underwrite it quicker than a new bank that would have to start from the scratch. And as we said, this is pure loan program, and banks have to apply their own underwriting standard. So it is going to take a little bit longer time for banks to approve compared to the PPP loan, because under PPP loan, banks didn't have to apply any kind of safety and soundness of the business standard, to my knowledge. While here, they will apply their normal underwriting standards,
Right. Yeah, that's a great point. I mean, all things being equal, if you have an existing relationship with a bank where they know a little bit about your business, they've clearly deemed you to be creditworthy in the past, you would think that that's a natural place to start.
Yes.
There's a question about whether or not the program is currently in operation. No, as I think I said earlier, I mean, this is not yet in operation, and frankly, I think it's a little bit surprising. The program was announced. Well, it was announced when the CARES Act was enacted on, I think, March 27th. We saw some loan terms announced by the Federal Reserve on April 9th. We saw an update to that on April 30 with, as I said, an expansion in who's eligible, an expansion in the amount of loan size. But surprisingly, at least to me, there is still no, the program is still not yet up and running. You cannot go and get this loan today. I certainly would hope and expect that this will be up and running relatively soon. Okay, well, we've got a couple of minutes for additional questions if there are any, and I'm happy to answer those. If there are not additional questions, I would just remind everybody that, our materials are going to be available to everyone within about 24 hours, as well as this recording of this session should be available in about 24 hours. And I've included here on the screen links to the Federal Reserve main page on this program. Frankly, even if you lose this link, you can just Google Federal Reserve Main Street Program or Main Street Lending Program, and you'll find it. I do anticipate they're going to continue to update it, and so we should have more information about this shortly. So, all right, well, thank you, everybody, for participating. Let me just, before we end in just a moment, let me go to the end, and I'll just put up my contact information and Suha's contact information. If you have any questions regarding any, this program or the PPP program that we talked about last week, or anything that occurs to you later, please don't hesitate to contact us, and we will do our best to respond to your questions. All right, thank you very much, everybody, for participating.
Thank you.